Question 1. Which of the following best describes the underwriting process for insurance policies? A. The underwriter's primary role is to determine the premium amounts for policies while ignoring the individual risk characteristics of applicants. B. Underwriting involves reviewing the application, inspecting the applicant's background, and determining the level of risk to determine whether to approve or decline the policy. C. The underwriting process is solely focused on determining the policyholder's premium based on their age and gender. The underwriting process includes setting premiums but does not require the assessment of the applicant's health status or occupation. Answer. B. Underwriting involves reviewing the application, inspecting the applicant's background, and determining the level of risk to determine whether to approve or decline the policy. Explanation. Underwriting is the process of evaluating the risk presented by an applicant and determining whether the insurance policy should be issued and at what premium. The process includes detailed review of the applicant's application, medical examinations, financial information, inspection reports, along with an assessment of their overall risk profile. The underwriter uses this information to classify the applicant and decide on whether the application will be approved or declined, and the premium will be determined accordingly. The other options either oversimplify or misstate the underwriting process. Question 2. Mr. Clark has applied for life insurance and his application has been approved. However, the insurance company finds that Mr. Clark had a significant heart condition that was not disclosed. What action should the insurance company take according to the principle of utmost good faith? A. The company should deny the claim for any future benefits, as non-disclosure is a violation of the contract. B. The company should continue with the policy but increase the premium amount to account for the undisclosed health risk. C. The company should re-evaluate the policy and, depending on the severity of the non-disclosure, either void the contract or adjust the coverage. D. The company should honor the policy without any changes since Mr. Condition is not related to the reason for the insurance application. Answer. C. The company should re-evaluate the policy and, depending on the severity of the non-disclosure, either void the contract or adjust the coverage. Explanation. The principle of utmost good faith, also known as Urami Fide, requires that both parties in an insurance contract disclose all relevant information truthfully. If a material fact, such as a significant health condition, is not disclosed, the insurer has the right to either void contract or adjust the policy's terms, which may include increasing premiums or changing coverage limits. In this case, the insurer must decide based on the severity of the non-disclosure and the materiality of the omitted information. Options A, B, and D are incorrect because they either overlook the principle of good faith or misinterpret the insurer's rights. Question 3, scenario-based. Ms. Robinson is seeking to purchase a life insurance policy. She has disclosed her age, gender, and health condition. However, during the underwriting process, the underwriter finds that Ms. Robinson has a risky occupation as a firefighter, which was not included in her initial application. What should the underwriter do to appropriately assess the risk and proceed with the application? A. Approve the policy as normal and ignore the occupation since it was not directly disclosed. B. Reclassify the risk based on the occupation and potentially increase the premium or add exclusions for job-related risks. C. Deny the application entirely since the occupation was not disclosed even though other factors were accurately reported. D. Approve the policy without any changes and allow the insurer to adjust the premium later on claims history. Answer. B. Reclassify the risk based on the occupation and potentially increase the premium or add exclusions for job-related risks. Explanation. Underwriting involves evaluating all relevant risk factors, including occupation. A risky occupation like firefighting may increase the likelihood of injury or death, affecting the overall risk profile. Therefore, the underwriter should reassess the application, reclassify the risk based on the new information, and adjust the terms of the policy accordingly. This could involve increasing the premium to account for the added risk or even adding exclusions related to work-related injuries. Ignoring the occupation, option A, or denying the policy outright, option C, would not be appropriate without considering all factors. Option D is also incorrect as the insurer must assess the risk upfront, not based on future claims history. Which of the following best describes the concept of indemnity in insurance contracts? A. Ensures that the policyholder can make a profit from a loss by paying more than the actual value of the loss. B. It aims to return the policyholder to the same financial position they were in before the loss occurred without allowing for profit. C. It allows the insurer to make a profit by covering only part of the loss. D. It is an exception clause in the insurance contract that limits the amount of coverage based on the value of the loss. Answer: B. It aims to return the policyholder to the same financial position they were in before the loss occurred, without allowing for profit. Explanation: the principle of indemnity ensures that insurance coverage only compensates the policyholder for the actual loss sustained, returning them to the same financial position they were in before the loss occurred. This principle prevents the policyholder from profiting from a loss. In the case of a total loss, compensation is limited to the value of the property, and any additional compensation would be a violation of this principle. The other options either misinterpret the concept of indemnity or involve incorrect principles. Question 5. Mr. Lee, a 45-year-old non-smoker, applies for a health insurance policy and discloses that he regularly engages in extreme sports. Based on underwriting guidelines, how should his risk classification be affected? A. His risk classification will remain unaffected since extreme sports are not a major factor in determining health insurance premiums. B. He will be classified as a standard risk since he is a non-smoker and the extreme sports risk is negligible. C. He will likely be classified as a substandard risk due to the higher likelihood of injury associated with extreme sports. D. He will be classified as a preferred risk due to his age and length of smoking habits, with no consideration given to his sports activities. Answer: C. He will likely be classified as a substandard risk due to the higher likelihood of injury associated with extreme sports. Explanation: underwriting guidelines consider a variety of factors, including lifestyle choices and health status. Engaging in extreme sports increases the likelihood of injury, which in turn increases the risk to the insurer. As a result, Mr. Lee would likely be classified as a substandard risk, meaning he could higher premiums or exclusions related to injuries from extreme sports. The other options ignore the potential risk posed by his activities. Question 6. Scenario-based. Mr. Thompson recently applied for a disability income insurance policy. During the underwriting process, the insurer discovers that Mr. Thompson has a history of back surgery, which he did not disclose on his application. How should the insurer proceed based on the principle of utmost good faith? A. The insurer should ignore the non-disclosure and proceed with the policy as originally applied for. B. The insurer should issue the policy but include a waiting period for back-related claims. C. The insurer should void the policy because Mr. Thompson failed to disclose a material fact. D. The insurer should increase the premium based on the disclosed medical history but keep the coverage intact. Answer: C. The insurer should void the policy because Mr. Thompson failed to disclose a material fact. Explanation: under the principle of utmost good faith, both the insurer and the insured are obligated to disclose all material facts that could affect the risk assessment. Mr. Thompson's history of back surgery is material fact that could significantly affect the insurer's decision to issue the policy or the terms of coverage. By failing to disclose this information, Mr. Thompson violated this principle, giving the insurer the right to void the policy. The other options are incorrect as they overlook the severity of the non-disclosure or suggest actions that are not in line with the contractual obligations of good faith. Question 7. Which of the following is an example of a non-forfeiture option in a life insurance policy? A. A policy loan where the policyholder borrows against the policy's cash value. B. Waiver of premium rider where premiums are waived if the policyholder becomes disabled. C. Reduced paid-up option where the policyholder stops paying premiums but retains reduced death benefit. D. An accelerated death benefit rider which allows the policyholder to receive part of the death benefit while still alive. Answer: C. A reduced paid-up option where the policyholder stops paying premiums but retains a reduced death benefit. Explanation: a non-forfeiture option allows a policyholder to retain some value or benefit from a life insurance policy even if they stop paying premiums. The reduced paid-up option is one such non-forfeiture option where the policyholder stops making premium payments but receives a reduced death benefit based on accumulated cash value. The other options, such as the policy loan or waiver of premium rider, are not non-forfeiture options, but rather additional policy provisions that address other aspects of the insurance contract. Question 8. Which of the following factors is not typically considered by underwriters when determining a risk classification for a life insurance applicant? A. The applicant's age and health history. B. The applicant's occupation and lifestyle choices. C. The applicant's geographic location and social security number. D. The applicant's medical exams and family medical history. Answer: C. The applicant's geographic location and social security number. Explanation: underwriters assess a variety of factors such as the applicant's age, health history, occupation, lifestyle choices, medical exams, and family medical history to determine risk classification. However, the geographic location and social security number are not directly relevant to determining risk classification, even though the location may influence factors. Mortality rates. The other options involve factors that underwriters typically review to assess risk levels and adjust premiums accordingly. Question 9. Which of the following is a characteristic of a term life insurance policy? A. It provides coverage for the entire lifetime of the insured as long as premiums are paid. B. It builds up cash value that the policyholder can borrow against or withdraw. C. It provides a death benefit for a specific period and expires at the end of the term if not renewed. D. It allows the policyholder to invest in various sub-accounts with returns based on market performance. Answer: C. It provides a death benefit for a specific period and expires at the end of the term if not renewed. Explanation: term life insurance provides coverage for a specific period, such as 10, 20, or 30 years, and pays a death benefit if the insured dies within that term. If the policyholder survives the term, the policy expires without any cash value being paid out. Options A, B, and D describe features of other types of life insurance, such as whole life or universal life, that provide lifetime coverage, cash value accumulation, or investment opportunities. Question 10. What is the purpose of reinsurance in the insurance industry? 8. To allow insurers to avoid claims payments by transferring the risk to another insurer. B. To provide financial support to a primary insurer by sharing risk and reducing the likelihood of insolvency. C. To ensure that the policyholder's claims are fully paid, regardless of the insurance company's financial status. D. To increase the primary insurer's profits by reducing claim payments to the policyholders. Answer: B. To provide financial support to a primary insurer by sharing risk and reducing the likelihood of insolvency. Explanation: reinsurance is a practice where an insurance company, the primary insurer, transfers a portion of its risk to another insurer, the reinsurer, to reduce its exposure to large claims. This helps stabilize the insurer's financial standing and reduces the likelihood of insolvency. Reinsurance does not avoid claims or directly increase profits, as it is designed to help spread the risk. The other options either misinterpret the purpose of reinsurance or suggest unrealistic practices. Question 11. Which of the following statements about the subrogation in insurance contracts is correct? A. Subrogation allows the insured to collect compensation from both the insurer and the third party responsible for the loss. B. Subrogation is the insurer's right to pursue recovery from third party responsible for loss after compensating the insured. C. Subrogation only applies in liability insurance and not in property insurance. D. Subrogation prevents the insurer from seeking compensation from the at-fault party after paying the insured. Answer: B. Subrogation is the insurer's right to pursue recovery from third party responsible for loss after compensating the insured. Explanation: subrogation is principle in insurance where, after the insurer compensates the insured for loss, the insurer assumes the right to recover the amount paid from the responsible third party. This helps keep the insurer's costs in check and ensures the policyholder does not receive windfall by recovering from both parties. Option is incorrect because the insurer cannot collect from both the insurer and the third party. Option C is incorrect because subrogation applies to both property and liability insurance. Option D is incorrect because subrogation specifically allows the insurer to pursue recovery. Question 12. When underwriting a life insurance policy, which of the following factors would most likely classify an applicant as a substandard risk? A. The applicant is a healthy non-smoker with no family history of serious illness. B. The applicant works in a low-risk occupation and participates in minimal physical activities. C. The applicant has a chronic medical condition and engages in high-risk recreational activities. D. The applicant is young and does not have any significant medical history. Answer: C. The applicant has a chronic medical condition and engages in high-risk recreational activities. Explanation: underwriters classify applicants based on risk factors such as health, occupation, and lifestyle. Chronic medical conditions and participation in high-risk activities such as extreme sports significantly increase the likelihood of claims, making the applicant a substandard risk. Substandard risks typically face higher premium. Policy exclusions: the other options describe low-risk factors, which would typically classify the applicant as standard or preferred. Question 13. Which of the following best defines the term proximate cause in relation to an insurance claim? A. It refers to the immediate and direct cause of a loss, regardless of other contributing factors. B. It is a secondary cause of loss that has no bearing on the outcome of a claim. C. It refers to the cause that, although indirectly related, is the most recent event leading to the loss. D. It is the primary underlying cause of a loss, regardless of whether it is covered under the policy. Answer A. It refers to the immediate and direct cause of a loss, regardless of other contributing factors. Explanation: proximate cause refers to the direct and immediate cause of a loss that sets in motion a chain of events leading to the loss. In insurance, it is crucial in determining whether a claim is valid, especially when there are multiple causes of loss. The insurer will focus on the proximate cause to assess liability. Options B, C, and D misinterpret the definition or application of proximate cause in insurance. Question 14, scenario-based. Mr. Adams, a 35-year-old non-smoker, has applied for a health insurance policy. During the underwriting process, the insurer discovers that he has a family history of heart disease, but Mr. Adams did not disclose this on his application. How should the insurer proceed? A. The insurer should issue the policy but exclude coverage for heart-related conditions. B. The insurer should increase the premium to account for the potential heart disease risk. C. The insurer should void the policy due to non-disclosure of material information. D. The insurer should provide the policy as applied for since family history does not affect the underwriting decision. Correct answer: C. The insurer should void the policy due to non-disclosure of material information. Explanation: under the principle of utmost good faith, the applicant is required to disclose all material information such as family history of heart disease, which could influence the insurer's decision. The insurer has the right to void the policy if the applicant fails to disclose material information, as this impacts the risk assessment. Option is incorrect, as exclusion clauses are not typically applied to non-disclosed information. Option B may apply in cases where the information is disclosed, but non-disclosure typically results in voiding the policy. Option D is incorrect because the family history could materially affect the underwriting decision. Question 15. What is the primary function of the insuring agreement in an insurance policy? A. To explain the exclusions and limitations of the policy. B. To define the types of coverage provided by the insurer. C. To outline the responsibilities of the policyholder. D. To list the premium payment schedule. Answer: B. To define the types of coverage provided by the insurer. Explanation: the insuring agreement is the part of the policy that outlines the coverage provided by the insurer, specifying the types of risks or perils covered under the policy. It defines the scope of the insurer's obligations to the policyholder. Option refers to the exclusions section of the policy. Option C refers to the conditions or duties of the insured, and option D refers to the declarations or premium section of the policy. Question 16. Which of the following would most likely result in a declined risk classification for an applicant applying for life insurance? A. The applicant is 45 years old and has a history of high cholesterol but is otherwise healthy. B. The applicant is 60 years old with a history of smoking and a recent heart attack. C. The applicant is 25 years old with no significant medical history or family history of illness. D. The applicant is 35 years old and participates in low-risk physical activities like swimming. Answer: B. The applicant is 60 years old with a history of smoking and a recent heart attack. Explanation: a declined risk classification typically results from an applicant having severe or unmanageable health risks, such as a recent heart attack or a significant history of smoking. In this case, the applicant is 60 years old, which increases the risk, and the recent heart attack further elevates the likelihood of future health issues, making the app unsuitable for coverage. The other options describe low risk factors or favorable health history. Question 17. Which of the following is not a typical provision found in a health insurance policy? A. Coverage for preventive care and wellness checks. B. Exclusion of coverage for pre-existing conditions. C. Coverage for elective surgeries that are not medically necessary. D. A waiting period before coverage for certain conditions begins. Answer: C. Coverage for elective surgeries that are not medically necessary. Explanation: health insurance policies typically exclude coverage for elective surgeries that are not deemed medically necessary. Preventive care, exclusions for pre-existing conditions, and waiting periods are common provisions. Elective surgeries, such as cosmetic procedures, are usually not covered unless specified by the policy. Question 18. Which of the following is an example of a loss prevention technique in risk management? A. Installing a security system to reduce the likelihood of theft. B. Paying out claims to policyholders promptly after a loss occurs. C. Purchasing additional insurance to cover potential losses. D. Increasing premiums to offset potential future claims. Answer A. Installing a security system to reduce the likelihood of theft. Explanation: loss prevention techniques aim to reduce the likelihood of a loss occurring. Installing a security system is an example of such a technique because it helps reduce the risk of theft or damage to property. Options B, C, and D are related to loss financing or claims management, not prevention. Question 19. Which of the following types of life insurance allows the policyholder to invest in a variety of separate accounts with returns based on market performance? A. Whole life insurance. B. Term life insurance. C. Universal life insurance. D. Variable life insurance. Answer: D. Variable life insurance. Explanation: variable life insurance provides the policyholder with the ability to invest in a variety of sub-accounts, which can be equities, bonds, or money market funds with returns based on market performance. The policyholder bears the investment risk. Whole life insurance offers fixed premiums and guaranteed death benefits. Term life insurance provides coverage for a set term, and universal insurance provides flexible premiums but does not involve separate investment accounts. Question 20. What is the purpose of a waiver of premium rider in a life insurance policy? A. It allows the policyholder to waive the premium for a specific time period. B. It waives the premium payments if the policyholder becomes disabled. C. It waives the need for medical underwriting when applying for additional coverage. D. It allows the insurer to waive any outstanding premiums after a claim is filed. Answer: B. It waives the premium payments if the policyholder becomes disabled. Explanation: a waiver of premium rider is an optional provision that allows the policyholder to stop paying premiums if they become disabled and are unable to work. This rider ensures that the policy remains in force despite the policyholder's disability. The other options do not accurately describe the purpose of the waiver of premium rider. Question 21. Which of the following best describes the concept of insurable interest in an insurance policy? A. The policyholder must have a legal right to receive benefits from the insurance policy. B. The policyholder must have a financial stake in the property or person being insured. C. The policyholder must have an emotional attachment to the insured item or person. D. The policyholder must have a history of claims against the insurer. Answer: B. The policyholder must have a financial stake in the property or person being insured. Explanation: insurable interest is a fundamental principle in insurance, meaning that the policyholder must have a financial interest in the property or person being insured. This ensures that insurance is used for risk management rather than speculation. For example, a person can insure their home because they would suffer financially from its loss, but they cannot insure a neighbor's house without a legitimate financial stake in it. The other options do not accurately define insurable interest in an insurance context. Question 22. Which of the following is a characteristic of a term life insurance? A. It provides lifelong coverage with premiums that increase as the insured gets older. B. It provides coverage for a specified period and pays a death benefit only if the insured dies during that term. C. It accumulates cash value that can be borrowed against by the policyholder. D. It covers the policyholder's entire estate, including real property and assets. Answer: B. It provides coverage for a specified period and pays a death benefit only if the insured dies during that term. Explanation: term life insurance is a policy that provides coverage for a specified term such as 10, 20, or 30 years and pays a death benefit only if the insured dies during that term. It does not accumulate cash value like permanent life insurance, e.g. whole life insurance. Option: it describes whole life insurance. Option C refers to permanent life insurance, and option D is a broader concept unrelated to life insurance specifically. Question 23, scenario-based. Jane is considering purchasing a homeowner's insurance policy. The policy includes $1,000 deductible. After severe storm, a roof is damaged and the cost of repairs is estimated at $4,500. How much will Jane receive from her insurance company after the deductible is applied? A. $4,500. B. $3,500. C. $1,000. D. $5,500. Answer B. $3,500. Explanation. The deductible is the amount the policyholder must pay out of pocket before the insurance company covers the remaining costs. In this case, Jane's deductible is $1,000. The total repair cost is $4,500, so the insurance company will pay $4,500. 1,000 nulls equals $3,500. Option is incorrect because it does not account for the deductible. Option C is incorrect as it refers to the deductible amount, not the payment after applying the deductible. Option D is incorrect because the amount exceeds the repair cost. Question 24. Which of the following is an example of moral hazard in insurance? A. A person driving recklessly because they know their auto insurance will cover the damage. B. A person installing a security system to prevent theft. C. A homeowner taking precautions to prevent fire hazards. D. A policyholder avoiding risky behavior to reduce the chance of injury. Answer A. The person driving recklessly because they know their auto insurance will cover the damage. Explanation. Moral hazard refers to the tendency of individuals to take on greater risks because they know they are protected by insurance. In this case, the driver's reckless behavior is influenced by the belief that their auto insurance will cover the damage. The other options describe actions taken to reduce risk or prevent loss, which are examples of good management, not moral hazard. Question 25. Which of the following is typically covered under a standard homeowner's insurance policy? A. Damage to the home caused by earthquakes. B. Damage to the home caused by flooding. C. Loss of personal property due to theft or fire. D. Maintenance costs for the home. Answer C. Loss of personal property due to theft or fire. Explanation. A standard homeowner's insurance policy generally covers damages to the home and personal property caused by covered perils such as fire, theft, or vandalism. Earthquake and flood damage are typically excluded unless separate coverage is purchased. Maintenance costs are the homeowner's responsibility and are not covered under insurance. Question 26. Which of the following is an example of negligence in the context of liability insurance? A. A person intentionally causes harm to another person. B. A person fails to clear snow from their driveway, causing someone to slip and fall. C. A person knowingly provides false information on an insurance application. D. A person experiences an injury due to a pre-existing medical condition. Answer B. A person fails to clear snow from their driveway, causing someone to slip and fall. Explanation. Negligence occurs when a person fails to exercise reasonable care, leading to harm or injury to another person. In this case, failing to clear snow and ice from the driveway is an act of negligence as it creates a hazardous condition. The other options involve intentional actions, A. Misrepresentation, C. Or pre-existing conditions, D. None are examples of negligence. Question 27, scenario-based. Sarah, who is covered under a comprehensive auto insurance policy, hits a deer while driving. Her car is damaged, but the deer runs away unharmed. What portion of the damages is covered by her insurance? A. Only the damage to the car. B. The damage to the car and the deer. C. Only the deer's injuries. D. Nothing, because the deer ran away unharmed. Answer A. Only the damage to the car. Explanation. Comprehensive auto insurance covers damages to the policyholder's vehicle caused by non-collision events, such as hitting an animal. However, it does not cover injuries or damages to the animal involved. In this case, the insurance will cover the cost to repair Sarah's car but will not pay for the deer's injuries. Option B is incorrect because the insurance only covers the car. Option C is incorrect as the insurance does not cover animal injuries. Option D is incorrect because the insurance covers property damage, not animal injuries. Question 28. What is the primary purpose of the coinsurance provision in a health insurance policy? A. To require the insured to pay a fixed amount for each medical service received. B. To share the cost of medical expenses between the insurer and the insured after the deductible is met. C. To prevent the insurer from covering any unnecessary medical treatments. D. To reduce the policyholder's premium payments by offering lower coverage limits. Answer B. To share the cost of medical expenses between the insurer and the insured after the deductible is met. Explanation. Coinsurance is a provision in health insurance where the insured and the insurer share the costs of covered medical expenses after the deductible has been met. Typically, the insurer covers a larger portion, e.g., 80%, and the insured pays the remainder, e.g., 20%. Option A describes a copayment, not coinsurance. Option C is not the purpose of coinsurance, and option D is incorrect because coinsurance does not directly affect the premium but rather the sharing of costs after the deductible. Question 29. Which of the following types of insurance provides coverage for professional mistakes or errors in judgment? A. Property insurance. B. Liability insurance. C. Professional liability insurance. D. Health insurance. Answer. C. Professional liability insurance. Explanation. Professional liability insurance, also known as errors and omissions (EO insurance), covers professionals such as doctors, lawyers, and accountants for mistakes or negligence in the services they provide. This type of insurance helps protect professionals from claims of inadequate work or advice. The other options do not provide coverage for professional errors. Property insurance covers physical. Liability insurance covers general accidents or injuries, and health insurance covers medical expenses. Question 30. Which of the following best describes the exclusions section of an insurance policy? A. It lists the benefits and coverage available under the policy. B. It specifies the circumstances under which the insurer will not pay a claim. C. It outlines the premium payment schedule and amounts. D. It provides details on the policyholder's responsibilities after a claim is filed. Answer. B. It specifies the circumstances under which the insurer will not pay a claim. Explanation. The exclusions section of an insurance policy outlines the risks, perils, or situations that are not covered by the policy. This section helps clarify the limits of coverage and avoid misunderstandings. Option A refers to the insuring agreement, option C refers to the declarations section, and option D describes the conditions or duties of the insured.